Why the market won't die? If you looked around your neighborhood, your town and city today, the economy looks like it's breaking. Small businesses are shuttering their doors at the fastest rate we've seen since the 2008 Great Financial Crisis. If you talk to young Americans, they'll tell you a different story than the headlines. Credit card delinquencies in that demographic have officially surpassed pandemic-era peaks. The data is stark. The average American household now requires an additional $11,400 per year just to maintain the exact same standard of living they had in 2021. By every traditional metric we have, manufacturing output, shipping volumes, real wages, we are in the teeth of a brutal recession. And yet, if you look at your trading screen, the world looks perfect. Nvidia and Microsoft are adding the equivalent of a mid-sized nation's entire GDP to their market caps in a single afternoon. To the average observer, this looks like a glitch in the matrix, a total paradox. How can the body of the economy be dying, while the heart of the stock market beats faster than ever? Most financial talking heads will tell you it's just forward-looking pricing or the AI revolution. But they are looking at the symptoms, not the disease. Here at the Macro Edit, we believe the truth is far darker. The stock market hasn't crashed because it is no longer allowed to crash. It has been transformed from a mechanism of price discovery into a utility of political survival. This is the story of the janitors of Wall Street, the hidden river of Japanese liquidity, and the secret mechanism banks use to transfer wealth from your savings account directly into their portfolios. The crash isn't missing. It's being hidden inside the value of your money. The day the free market died, what Wall Street's janitors did. To understand why the market won't fall today, we have to travel back to a Monday that changed the DNA of American capitalism forever. October 19th, 1987. Black Monday. Imagine the floor of the New York Stock Exchange. There are no algorithms here, only men in sweat-soaked shirts screaming into black rotary phones. Without warning, the floor fell out. The Dow Jones Industrial Average plummeted 22.6% in a single trading session. It remains the largest one-day percentage drop in human history. To put that in perspective today, a similar drop would wipe out nearly $10 trillion in wealth before lunch. There was no war, no sudden bank failure. It was a pure liquidity panic. The machinery of the market simply broke. In the aftermath, the ruling class realized something terrifying. If the market could die that easily, so could their power. In the wake of the carnage, President Ronald Reagan signed Executive Order 12631. On paper, it was a boring bureaucratic measure that established the Working Group on Financial Markets. But on the 31st floor of the big banks, it became known by a more sinister name, the Plunge Protection Team. This order gave the Secretary of the Treasury, the Chairman of the Federal Reserve, and the heads of the SEC the legal authority to coordinate in times of crisis. While the government officially denies they intervened to prop up stock prices, the janitors leave footprints everywhere. Think back to the 2023 banking panic. When Silicon Valley Bank collapsed and the markets began to gap down, we saw mysterious, massive buying of futures contracts at the exact moment the S&P 500 hit key support levels. Someone, with infinite pockets, was stepping in to scrub the blood off the floor before the public woke up. The market is no longer free. It is a managed utility. Because if the stock market crashes, the pension funds evaporate. If the pension funds evaporate, the tax receipts vanish. And if those receipts vanish, the $38 trillion US debt bubble finally pops. The janitors aren't saving the economy. They are saving the system's ability to borrow. The Cantillon engine. If you want to understand the hidden history of money before the next cleanup operation begins, make sure you subscribe to the Macro Edit. We dig into the stories the textbooks are paid to leave out. But the Plunge Protection Team was just the shield. To make the market rise forever, they needed a sword. And they found it in a theory developed by an 18th century Irish banker, Richard Cantillon. If you are confused why stocks go up while your grocery bill makes you want to cry, you are a victim of the Cantillon Effect. Cantillon observed a brutal truth. Money is not neutral. When a central bank prints $1 trillion, that money does not enter the economy like a fine mist, falling evenly on everyone. It enters like a river, at a specific point. Those who are close to the river, the ones who receive the new money first, get to spend it while prices are still low. In our modern world, that point of entry is the banking sector. When the Federal Reserve injects liquidity, they don't mail checks to plumbers or teachers. They buy bonds from hedge funds. They buy mortgage-backed securities from Tier 1 banks. This is the proximity rule. The banks and the 1% get the fresh cash first. They immediately use that free money to buy stocks, luxury real estate, and high-yield assets. This massive wave of buying pressure pushes the stock market to all-time highs. By the time that money finally trickles down to your wages or your small business 3 years later, it has already caused the price of everything to rise. You get the money last, after the inflation has already arrived. You are essentially paying for the wealth of the people who got the money first. This is why the recession is real for you, but invisible for Wall Street. You are paying the higher prices caused by the printing. They are receiving the printed money that causes the prices. But even the Fed's printing press isn't enough to keep this illusion alive. To truly understand why the S&P 500 refuses to die, we have to look 6,700 miles to the east, to a silent, overseas ally who has been providing the infinite money glitch for 30 years. The Bank of Japan has been the primary financier of this system for 3 decades, while the rest of the world dealt with inflation. Japan did something unprecedented. They kept interest rates at zero and often below zero. This created the greatest arbitrage opportunity in financial history, the yen carry trade. Here is how this smart money plays the game. A Wall Street hedge fund borrows $1 billion worth of yen from a Japanese bank. Because interest rates in Japan were 0%, that loan cost them almost nothing to maintain. They then immediately convert that yen into US dollars and dump it into high-growth assets, Nvidia, Microsoft, or Bitcoin. It is effectively free leverage. This fire hose of liquidity has nothing to do with American productivity or the health of the US consumer. It is a mathematical loophole. This trade is so massive that when the Bank of Japan merely hinted at raising interest rates in August 2024, the global markets suffered a heart attack. In just 48 hours, the Nikkei saw its largest dump in history. Why? Because when the cost of borrowing yen goes up, the infinite money glitch turns off. Hedge funds are forced to sell their US stocks to pay back those Japanese loans. The only reason the market hasn't crashed yet is that the Bank of Japan is terrified to pull the plug. They are in a hostage situation. If they raise rates to save their own currency, they crash the US stock market. We are witnessing the gears of this global liquidity machine grinding to a halt. The US market is being propped up by a foreign central bank that is slowly running out of oxygen. But there is a third reason why the market refuses to die. It's not just the janitors or Japan, it's you. Or more specifically, your 401k. We have entered the era of the blind giant, otherwise known as passive investing. In the 80s and 90s, stock prices were determined by active managers. These were people who actually looked at a company's balance sheet. If a company was failing, they sold. Today, that feedback loop is broken. The market is now dominated by passive flows. Every 2 weeks, millions of Americans have money automatically deducted from their paychecks. That money is funneled directly into massive index funds managed by Vanguard and BlackRock. These funds operate on an algorithm that has a no-sell mandate. By law and by structure, they must buy the S&P 500 companies, regardless of the price, regardless of the PE ratio, and regardless of whether the company is actually profitable. This has created a price-insensitive buyer. Imagine a grocery store where a giant robot comes in every morning and buys every loaf of bread in the building. It no matter if the price is $2 or $200. What happens to the price of bread? It goes to the moon, not because the bread is better, but because the buyer literally cannot say no. The stock market hasn't crashed because the mechanism for crashing, the ability to sell based on bad news, has been overwhelmed by the automatic, mindless buying of the retirement complex. It is a forced bid, but this creates a terrifying structural weakness. The market has lost its ability to signal danger. It's like a car where the speedometer is glued to 70 miles per hour, even as the engine begins to smoke. Let's look at the data the big banks desperately hope you never analyze. If you measure the S&P 500 in US dollars, it looks like a rocket ship. It's up over 20% in the last year. Your brokerage account is green, and on paper, you're wealthier than ever. But we have to ask the uncomfortable question. Are you actually getting richer? Or is the money you're using to measure your wealth simply melting away? To find the truth, we have to measure the market in something the Fed cannot print: gold. When you price the S&P 500 in gold ounces, the great bull market of 2025 evaporates. In late 2025, with gold screaming toward $4,500 an ounce, the S&P 500 to gold ratio has collapsed to approximately 1.52. Why does that number matter? Because it's the same level we saw during the chaos of the 2020 pandemic. In real terms, the stock market hasn't gained value. It has simply floated higher on a sea of devalued currency. Your gains are an accounting trick. The banks know that if the stock market crashes, the illusion of solvency breaks. So, they have made a calculated choice. They will sacrifice the value of the dollar to save the value of the S&P 500. This is an inflationary melt-up. We saw it in Weimar Germany in 1923. We saw it in Venezuela in 2016. In both cases, as the economy collapsed and people went hungry, the stock market actually went up. Why? Because nobody wanted to hold the currency. Everyone was panic buying stocks because they knew the money in their pocket was melting like ice in the sun. The market hasn't crashed because it has become a lifeboat, but even lifeboats can sink if they're carrying too much weight. There is a technical reason why the crash hasn't happened yet in 2025, and it involves a facility at the Federal Reserve called the reverse repo market. Think of this as a giant $2.5 trillion bathtub of emergency liquidity. During the pandemic, the Fed flooded the system with too much cash. Banks parked it at the Fed in this reverse repo facility. It was the financial system's secret savings account. Over the last 24 months, while the Fed publicly claimed they were tightening the economy, they were quietly allowing this $2.5 trillion bathtub to drain back out into the market. This massive flow of liquidity acted as a cushion. It was a stealth bailout that kept stocks inflated while you struggled with 7% mortgage rates. But as we sit here in late 2025, there is a problem. The bathtub is empty. The reverse repo balance has hit near zero. The hidden hose of liquidity has run dry. We are already seeing signs of stress. Banks are now frantically tapping the Fed's standing repo facility, SRF, a desperate pressure valve used when the private market refuses to lend. Usage of this facility has spiked to levels not seen since the 2020 crash. The Fed is out of leftovers. They are standing on the edge of a liquidity cliff with no safety net below. While the public remains transfixed by the neon lights of the stock market, the real ROD has migrated into the shadows. Since 2008, it's been harder for traditional banks to lend to zombies, risky and profitable companies. But the debt didn't disappear. It moved into private credit. This is an opaque, unregulated market estimated at over $2.1 trillion as we move into 2026. Unlike public stocks, these loans are not marked to market every day. This means that even if a borrower hasn't made a payment in 6 months, the lender doesn't have to admit the loss on their books. They call it extend and pretend. We call it a systemic time bomb. Institutions like Norinchukin Bank in Japan, U.S. insurance companies, and pension funds have loaded their balance sheets with these private loans. They are sitting on billions in unrealized losses. The market hasn't crashed because the price of this debt is being held constant by accounting tricks. It is a suspended animation of insolvency. The final trigger for the next massive correction is a boring 1,000-page piece of regulation, the Basel III Endgame. Set for implementation in the 2026 window, these rules will require large U.S. banks to hold significantly more capital against their risky assets. CEOs like Jamie Dimon have been furiously lobbying to kill these rules. Why? Because to meet these requirements, banks will be forced to sell assets. They will have to pull back on lending. This creates a credit crunch. As banks hoard cash to satisfy regulators, liquidity, the lifeblood of the stock market, is legally mandated to disappear. If these rules pass as written, the artificial liquidity supporting the S&P 500 will be legally sucked out of the system. The janitors won't be able to help. They'll be too busy trying to save their own balance sheets. If these rules pass as written, the artificial liquidity supporting the S&P 500 will be legally sucked out of the system. The janitors won't be able to help. They'll be too busy trying to save their own balance sheets. So, why hasn't it crashed yet? Because the transfer of wealth is not finished. In his landmark research, analyst David Webb uncovered a silent change to the Uniform Commercial Code, or the UCC, that has fundamentally altered property rights in the United States. Most of you watching this believe you own your stocks. You think if you buy a share of Apple or Tesla, it belongs to you. But legally, since the late 1990s, you are merely a beneficial owner holding what is called a security entitlement. The real legal owner of almost all publicly traded stock in the U.S. is a centralized entity known as Seed and Company. Why does this matter? Because in the event of a systemic collapse, a true everything crash, your assets are legally considered collateral for the bank's massive derivatives debts. Under the new laws, the secured creditors, the big banks, get paid first. You, the retail investor, are at the back of the line. The banks don't want the market to crash yet because they need you, the exit liquidity, to stay fully invested. They need your pension money, your 401k, and your savings to provide the volume they need to slowly unload their positions. They are selling the top to you, while they position themselves in hard assets, land, water rights, and infrastructure. We see this in the insider selling metrics of late 2025. CEOs like Jeff Bezos and Mark Zuckerberg have been offloading billions of dollars of their own shares at these record highs. They aren't diversifying. They are cashing out of a burning building. I want to hear your theory on this. Do you think the insiders are selling because they see the Basel III guillotine coming? Or is this just routine business? Leave a comment below. It helps this community understand the sentiment of people who are actually paying attention, coming to the end of the cycle. History shows us that financial engineering works for a long time, until it suddenly doesn't. The Roman Empire clipped their silver coins to fund wars, until the denarius became worthless. The French monarchy used paper shares to inflate the Mississippi bubble, until those shares returned to their intrinsic value, zero. The American stock market in late 2025 is suspended in midair by the greatest monetary experiment in human history. It hasn't crashed because the full force of the government, the central bank, and the global banking cartel is being used to prevent reality from setting in. But the laws of economics are like the laws of physics. You can delay gravity, but you cannot defy it. The crash, when it finally arrives, may not look like 1929. It might be a crash in purchasing power, where the Dow hits 60,000, but a loaf of bread costs $50. That janitors will save the number on the screen, but they will burn the money in your pocket to do it. The banks have made their move. They have moved into the lifeboats. The question is, what is your wealth actually worth when the illusion fades? This is the macro edit. If you want to stay ahead of the curve, make sure you've subscribed and rung the bell. Knowledge is the only asset they can't repossess. We'll see you in the next one.